brand manager of the East West Bank.
Thank you.
Today we partner with the Rex Smart, right? But that's Belinda. I'm the brand manager in this location for 14 years, and I handling all the commercial loan, small business loan, SBA, credit line, and trade finance, commercial and multifamily and residential. Okay.
Hi, I'm Jim Anderson, business relationship manager. All I do is business loans, so that's my job. Been in banking 15 years, more than that actually. So what we try to do to differentiate our bank is we're going to share a lot with you. We're going to teach you a lot. So it's not, anything we know, we're going to try to share with you.
My name is Joe Budka. Thank you all for coming out today. I'm very excited to share with you some really cool and interesting real estate investing concepts and ideas. Rich is my partner. He's a broker, managing broker at Remax.
We got a good lineup here. We got Jim from East West and Financing. We got a CPA to answer all your questions.
We're going to talk a little bit about two different asset classes today. Let's see. There's 5+. All right. Does anybody know the difference between, say, a 4-plex and a 5+ unit commercial building? There's quite a difference. When you go for a 2 to 4 unit apartment building, that's considered residential, and so we're going to be focusing a little bit more on the 5+ unit buildings, and there's a lot of reasons why we like to focus on that and like to promote that for our investors as well. The other thing we're going to talk about is triple net lease investments. So this is probably a triple net lease investment right here that we're sitting in today. But basically it's pretty simple. You drive down any busy street in any town, and you're going to see McDonald's on the side of the road, Subway, AutoZone. These are all buildings that are actually owned by mom and pop landlords like me or yourself. What's really funny is people always assume that this is a big investment and millions and millions of dollars, and you got to be an accredited investor, so on and so forth. But the fact is, people like me or you own these things all day long. First of all, just a little bit of apartment buildings. Let's see here. These are the main reasons why I like to invest in apartment buildings and why I promote investments in apartment buildings so much. What's really cool is, number one, cash flow. At the end of the day, the idea is to exit. I mean, has anybody ever read Robert Kiyosaki's Rich Dad Poor Dad? Yeah, okay. So, I mean, what does he say in that book? Basically, at the end of the day, what do you want to do with your life? Do you want to relax and do you want to hang out with family, or do you want to be working every single day for the rest of your life till you're 65, retire, you got 10 to 20 years left, and oh my gosh, your retirement's out, and you have to move in with family or whatever. Robert Kiyosaki, he's a personal finance guru, and he always promotes basically acquiring assets to increase your monthly cash flow, which will allow you to step out of the rat race, which is the day-to-day grind, working at a job. So that's the main thing about apartment buildings. It provides cash flow. And what is cash flow? Cash flow is when you have an asset and you have income coming in and you got expenses. And what you do is you minus the you take the income and you deduct the expenses. And at the end of the day, after your mortgage and everything, what's left over is your monthly cash flow. So that's why we like apartment buildings, because it puts money in your pocket without you having to work. The other thing about apartment buildings, which is pretty awesome, is you can actually force appreciation. So unlike back in 05, 06, 07, where everybody was banking on the house next door to go up so they could sell their house for double what they bought the year before, you can actually force appreciation, not based on the market, but based on the way you manage the property. We'll talk about that a little more in detail later, but essentially what you do is apartment buildings are actually evaluated on the cash flow that it produces. So if an apartment building produces $100,000, maybe it's worth $1 million, but if you raise rents, you can actually increase the value based on the new income, and maybe now it's worth $2 million. The other thing about apartment buildings, which is great, is economies of scale. So, I've got some investors who live in the Midwest, and they buy 20 or 30 or 40 different houses, and that's an interesting way to invest. But the thing is, they have one house, and then that's one roof, and then you got another house and that's another roof. So if a bunch of roofs fall apart, you've got to send out people to repair all those roofs. If you have an apartment building, well, you got one roof, and if it needs repair, you just send your property manager out there, go out there yourself, whatever you do, fix that. But it gives you the ability to kind of consolidate your holdings under one roof. So the other thing which is great too is everybody's looking at foreclosures these days, and everybody's bidding foreclosures up. That's a really, really competitive market. Rich and I were making offers last week on a foreclosure. I think it was in the East Bay. Long story short, there was like 35 other investors trying to buy it. So in the apartment world, you go to make an offer on a building, you got like 1 or 2 people who are doing the same. So it gives you an edge in that respect.
Hey, Joey, can I add something?
Yes, sir.
One thing that from the bank's perspective on apartment complex, they're the strongest asset. When we went through the crisis of the mortgage crisis, mostly it was residential properties that were in the books that was all mostly bad. Just to share with you all, we're very aggressive with the apartment complex because of that reason. When we looked at the portfolio coming out of the recession, apartments have the top performing asset of the bank. So that should give you confidence that when you buy an apartment, it's going to basically take care of itself.
What is a pro forma and what are current rents? So current rents are basically whatever the property is cash flowing at today, whatever the gross rents are. So if you take every single unit in the apartment building, you add up the monthly rents times 12 for the year, that's your gross rents. Okay, and then you take the expenses, deduct that, and you got your cash flow.
We don't use pro forma. You give us a property, as long as that property is performing, let's just say it's below. I don't want to go into too much numbers, but basically, when you invest in an apartment complex, before you even get to bid on that property, I have to run the cash flow on it. So when I come back to Joey or Rich and say, you know what, this property is good to go, that should give you confidence that the property itself cash flows and the bank's comfortable to lend. Let's just say the rents aren't there. You got 3 vacancy and it's like, a quarter of the total units available. So it's going to cause the gross rents to be low versus the expenses, so it's not going to cash flow from the bank's perspective. We will still possibly lend on that. What we'll ask is, can you give us some reserves? We know you're going to buy this property. We know you're going to renovate it, increase the rent to market. So what we'll do is we'll give you a contingency plan or a condition. We keep like maybe 12 months of reserves for us, meaning payments. And once that 12 months is up, then I'll rerun the cash flow on it. If it's up to par, we'll release it and you're good to go. So we'll be flexible on this. But the nice thing is some banks won't even touch it. But we'll consider it, depending on your profile too. I mean, if you're strong, cash flow wise, asset wise, we'll make exceptions.
Also, currently, East West Bank have a program, we don't charge for the bank fee for the apartment loan.
We're waiving $3,500.
We're waiving the bank fee. The total like $3,500. We're waiving right now, and we could do the pre-qualify for you. What we need from you like 3-year tax return from personal tax return, 3-year business and personal financial statement, and the profit and loss and rent roll. We can do the pre-qualify if you could provide those for us. And the profile we don't verify income. We don't need a tax return. Yeah.
East West Bank is in a dozen or more states, so in any state that they're located, they'll loan all day. You got 20 apartment units, right? And let's just say somebody leaves, somebody finds a better place to live. Well, that's 1 out of 20 that you have to worry about, 1 out of 20 units. So let's just say, what's that? That's like a 2.5% vacancy. What's great is, the chances of somebody leaving and then the rest of the 19 people leaving and not giving you guys any cash flow for that apartment building is very diversification to have the cash flow of 20 different tenants as opposed to maybe one single family home. If you have a single family home as an investment, the tenant moves out, cash flow dries up, you got expenses, taxes, insurance, maintenance, all that. It starts to add up and it gives you great diversification to have the cash flow of multiple rentals. So this is what I was talking about with forced appreciation. Rich has a client who bought a fourplex actually in Santa Clara. Bought it for $925, I believe, something like that. which does a really good job at property management. So he got in there, made some deals with tenants, raised rents. It was justified by the way he managed the property. You know, he put new shrubbery in, new toilets, things like that, increased the value of the property, invested some money into it, and as a result, he was able to raise rents. When you raise rents, as we talked about earlier, that increases the value of the apartment building. So it was bought from $925, invested a little bit of money into it, raised rents. Within 3 or 4 month period, that apartment building actually went up to about 1.1 million in value. So it's pretty good return on investment if you annualize that.
980 actually. 980.
So this is a good example right here. This was a client I was helping out a while back.
What is the ratio between rent versus the value of the property? Because, you know, if you raise rent, you raise the property price. What is that ratio?
You know, it really depends. But the metric that investors use in this state, in this area, is cap rate to evaluate apartment building, and that's general for the most part. And any apartment market most investors are going to look at cap rate as the main indicator. There's gross rent multipliers, some other metrics that people look at when they buy apartment buildings. But when you look at the cap rate, that's the cash return. If you paid all cash for a property, and then the monthly cash flow you get from that, that would be the cap rate. So the direct answer to your question is investors look at the metric, which is the cap rate in this area. So the cap rate it really depends on the area, some other things, but in the area that Rich had the apartment client in Santa Clara, market cap is about like 4.5%. So if you buy $1 million building and the cap rate was 4.5, then the monthly cash flow would be the annual cash flow would be $45,000 a year. So you take 45,000 divided by $1 million, and that's 4.5% cap rate. What you do is maybe if you buy that apartment building at a 4.5 cap rate, but the rents are currently under market, you can raise the rents to market levels and increase the cap rate, and that increases the value of your property. Economy of scale, we touched basis on this a little bit earlier, but you got one roof, you got 16 tenants. Needless to say, it makes for a better operation. There's apartment operators. One fellow, his name's Todd Speaker. This guy owns 3,000 units in the Bay Area. He's an apartment freak, I like to say. He's got 80 unit apartment buildings, 16 unit apartment buildings. He only invests in apartment buildings, but when I talked to the guy the other day with my brother, he said, Joey, it's tough to get a hold of this guy, but needless to say, I had to ask him, hey, what's the secret sauce? He said, it's all about economies of scale. You get apartment buildings, it's great. If you have single family homes, the cap rate goes down for the most part, and of course, you don't have that economy of scale factor. Look that guy up, by the way. He's an apartment legend in the Bay Area. So we mentioned earlier that investors are going after foreclosures like crazy. The market's really like saturated. Maybe 20 years ago, you had 2 or 3 people show up to the court steps when they were going to buy foreclosures. Today, you got a massive crowd of investors swarming to get that foreclosure, and when they finally pay all cash for it at the end of the day, there's really no room for a return on investment. They try to flip it or rent it out for cash flow, but because that market's saturated, it's really hard to get a good return on these single-family homes. I have a good friend who made an offer on an apartment building last week. It was just him and one other investor. They're making offers back and forth, but eventually, I guess he actually lost out on the deal. But there's a much better chance that if there's a good deal that pops up, you'll be able to get in there and with a competitive offer, get that thing under contract. Go ahead.
Our bank has the only program for apartment complex, no dog. That's we have 4 dogs, we go 4 dogs, but one of the best benefits of us is the most popular program is we'll go 40% down and 60% loan, and we're going to require your tax return. The only thing I'm going to run is the cash flow on the apartment.
In the business, you're investing in the property. So these properties, Signed they're really long-term leases signed with multinational corporations, Walgreens, etc. And you know, you got 25 years on the lease of guaranteed payments. The only catch to these investments is if the corporation fails, then through bankruptcy proceedings, they can actually get out of the lease. But you know, Walgreens doesn't go bankrupt every day. So generally, these are perceived as really, really safe, long-term, good hold investments.
A little bit. Yeah, these are, again, probably the second best performing asset, the single tenant. When you're looking at like big corporations, that's for a tenant. One thing that comes up on these properties, the lease. If you're looking at these properties, make sure the lease is, you got like 7 years left or something, because usually most banks are gonna match the lease with the term of your loan, okay? I don't know if y'all know that, but that's how the underwriters will do it. With our bank, we'll be flexible. You know, if you've given me a strong profile, we'll take a look at that. If you want a longer term, we can probably squeeze out a longer term, like a 7-year, 10-year fixed term versus like a 5-year lease that's left on the lease. So normally they won't go past whatever the remaining lease on these properties are. So, but they are very good assets.
I was wondering, what are some of the price ranges for these?
It's a really good question. It's pretty vast, actually. Anywhere from, you know, I had a really good client who was making, put out some LOIs on properties that were around 700,000. I saw a Pizza Hut that was going for 600,000 with 15 years on the lease. So it really depends. Then I've got a client I met with on Thursday, and he was like, "Oh, what do you got in the 20 million range?" And there are properties out there in the 20, 30, 40 million dollar range. But so it really depends on you. And that, yeah, go ahead, man.
What's the cap rate on that Pizza Hut?
On the Pizza Hut, it was 6.75. Yeah. So we'll go into more detail here. But does anybody invest in these regularly or have a little bit of experience? It's kind of like an asset class that's hidden. It's like, you know, it's a lot of old grandmas own these things, and you know, massive like real estate investment trusts buy like 20 Walgreens at a time. But the mom and pop investor usually doesn't know much about these, so I figured I'd ask. But anyway, so yeah, they're 100% passive. Tenant actually pays for all the taxes. They pay the insurance. They pay for the maintenance. They manage the property. They do absolutely everything. They've got anywhere from you know, 5 to 25, 30-year leases. CVS and Walgreens usually have a 25 to 30-year lease, or McDonald's, very, very safe. The cap rate's usually a little lower because there's more certainty that you're going to get your return on investment. Then you got stuff like Burger King. You can get like 6.5 cap on some strong franchise properties. So there's a difference. There's franchisees, you know, a franchisee Burger King, and then there's corporate Burger King. Corporate Burger King, you're going to have a little bit more stability, supposedly. So you're going to have a little bit lower return. 5.5 cap is pretty typical. Starbucks does double net a lot of times. Double net is they just pay for the taxes and insurance. Sometimes you have to take care of the property. Usually I like to put my clients in a triple net lease. That's the most ideal situation. So yeah, I see this as like the end game. My partner Rich, he just had a baby, and ultimately he wants to be sitting down, just, you know, hanging out with his kids. I want to do the same thing, have no worries, and this is sort of like the end solution to really satisfy all your cash flow income needs in retirement. So yeah, when we go through these investments, I mean, you know, basically this is 100% passive. As I mentioned, you know, this is a great retirement investment, but it's also a really good freezer investment. And what I mean by that is, right now we're in a really heated market. I mean, you got apartment buildings increasing, you know, 20% a day. I mean, that's an exaggeration, but I mean, it a lot of times it doesn't make sense when an apartment building hits the open market, when it's listed with the broker, to actually to buy that for cash flow. In the Bay Area, you buy for appreciation for the most part, and if you get a good deal, you can have a decent, you know, 7, 8 cap if you're lucky. But for the most part, you know, apartment buildings are very overpriced. So what a lot of investors are doing are actually exchanging into these freezer investments with long-term leases. So you have maybe an apartment building that's giving you like a 4.5 cap rate. That return sucks. That's actually really low. When you get into maybe like a Burger King, strong franchisee, you can get a 6.5, 7 cap, and with a little bit of leverage from East West Bank or some other firm, you can increase your total return, which is calculated by the cash flow and your principal pay down, you can increase it generally to above 10%, which is a very good return. So these are like freezer investments and or retirement investments. It's a good time to basically freeze your net worth, make a really good return. Once the market comes back down and it's a little more reasonable here, and you can get a good cap rate on an apartment building down the street, then it's a good time to exchange back into apartment buildings. Back to the idea of not having to do anything with the property, you literally get mail money. So they're taking care of the taxes. Sometimes you have to pay the taxes, they reimburse you, but generally speaking, they're 100% passive. You sit back, they take care of all the maintenance. It's a really good. Go out and make offers on these things, and you look at the leases. That's key. Lease equals value with triple net properties. So you want to have a good broker and or attorney or CPA to help you out when you're looking at the leases to really make sure that's truly triple net, meaning that there's no responsibility on your part for the landlord. Sometimes these corporations get really tricky and they include some clauses in the contracts that say, oh yeah, landlord's responsible for maintaining the grass outside, or you have to take care of the insurance. True triple net would not be a property like that. So you want to have somebody who gives you the help with the due diligence to make sure you're getting into a good deal. This is an offering memorandum. So when you look at triple net properties, or actually any commercial real estate for the most part, you look at this offering memorandum. It's basically a marketing package that just details the investment, what the lease is all about, so a synopsis of the deal. So it gives you a really good snapshot of what type of investment you're getting into. This is a property my brother and I worked on some time ago, actually at the beginning of the year. Client actually had a apartment building downtown San Jose. They were making about 4.2% return. You can get that maybe invested in bonds. So it's pretty pitiful when you look at the potential of getting into something like this. So they said, Joey, Alex, were alternatives. We said Burger King, this is, what was it listed at? I think it was a 6.25 cap rate. But they came in all cash after they sold their apartment building here. The apartment building that they're getting a really low return on, and with that cash they reinvested, didn't have to pay any capital gains, used a 1031 tax deferred exchange, and now they're just sitting on mail money that comes in monthly with no hassle. So this property actually had 20 years on the initial term, but there are 15 years remaining. So there's probably 14 and a half years. We always recommend maybe exchanging every 5 to 10 years just so the lease doesn't get old. You don't want to be stuck with the property with like 6 months left on the lease and the tenant says, oh my gosh, I'm vacating. You want to have a 5 to 10 year margin where you can exchange out and get into a longer lease. You always want to maintain a really long-term lease. In the event of rising interest rates, right? If you say buy a triple net investment and you're locked in at a certain cap rate, right? What would you do essentially? So when interest rates go up, cap rates follow. So interest rates that are set by the Federal Reserve, or whatever market fluctuations are happening, that equate to rising interest rates. What happens is cap rates follow along. It may be like 2-3 month delay for cap rates to kind of follow suit, but cap rates keep a margin between interest rates, so that there's always going to be a spread where cap rates are always steady ahead of interest rates. There's always got to be that margin so that investors have incentive to invest in properties like this. So to answer your question directly, I would recommend exchanging out of, if you're in a property and you're getting a cap rate that's 6.5 right now, but maybe interest rates go up to 6%, cap rates are going to go up. So I would say either reinvest in another property, refinance, go buy something else, but don't remain locked in the triple net investment. You can always exchange. So that's a property with 15 years on the lease. The corporation is actually a large franchisee. Strategic Restaurant Group is the largest franchisee of Burger Kings in the nation, or second largest, one of the two. So that's the equivalent of a corporation, a corporate guarantee. So you got the corporation, which is a large franchisee, guaranteeing this lease, and the only way that they wouldn't have to pay this lease is if they defaulted. And if they default, this country is probably in bigger trouble than your lease. So it's a stable investment with a strong franchisee. You always want to look at the lease again on these things and make sure that the backing is going to have 1 to 2% rental escalations every year or every 5 years or something like that. The downside to get into a Walgreens, which is extremely stable, that any bank will lend on any day of the week, is that the rent is fixed for 25 years. So if interest rates go up, maybe you need to exchange out into something that with a higher cap rate. I'm just going to briefly discuss 1031 exchanges because Chris Chu, the CPA, who will be talking a little bit more in detail about that, is going to go over that. But this is just a little scenario I go over with a lot of my clients who are considering doing an exchange. So let's just say you own a house, right? It's probably, especially in this area, probably earning 2 to 3% return cap rate. So what I'm always recommending is stop having that equity earn such a low return and put it to work for you. Don't become a victim of low cash flow and inflation eating away at your principal. Let's just say inflation is 1, 2, 3% a year. If your cap rate is 1, 2, 3%, then you're not making any return unless it's appreciating. So this is an example of exchanging into apartments, but the way a 1031 exchange works is basically you have a property and you would like to sell it and defer all your gains. Maybe you bought it for $100,000, now it's worth $200,000. There's $100,000 in gains, so that's all taxable. If you sold it today, you get taxed whatever the capital gains rate is today, 35%, something like that. And Uncle Sam would be knocking on your door next year come tax time and say, hey, where's my money? You don't want to do that. You want to defer that exchange and get into something that's going to give you a higher return. So basically, you got 45 days to make sure you got a few properties figured out. One of the 3 you got to close on in 180 days. And if you work with a good broker, you can actually extend the escrow period so that you don't have to worry about the crunch time. You can put 30-day extensions in the purchase contract so you're not crunched on that 45-day identification period. So this is all like kind of technical stuff. Chris will explain a little bit more in detail, but rest assured you work with a good broker, you'll be taken care of. Cool. So this is just kind of quick little snapshot about what we do for you guys. If you want to get into something, we'd be happy to help you out. But we just help you go through all the due diligence, understanding whether it be an apartment building or a group of single-family homes or whatever exchange or property that you want to get into. This is all the service that we provide. Rich has a portfolio of apartments actually here in the Bay Area, so he knows where a lot of our clients are coming from. I invested a lot back in during the end of the crisis, 09, 2010, on some property back in Pittsburgh, Pennsylvania. But we just want to make sure that you guys always get into a great location. If you're going to do a triple net lease investment, make sure you look at the tenant. Is the lease guaranteed by a strong corporation? That's a huge question to look at. What's the rent to sales ratio? So this is something that's very important for Burger King's triple net lease investments. If you look at the sales that a Burger King has, how many burgers are they selling a year? Add that up, and basically you got the rent. Maybe it's $100,000 a year, and their sales, maybe it's $1 million a year. The rent to sales ratio is 10%, 100,000 divided by $1 million. So it's a strong location, and it's a good investment if it's generally speaking below 10%. If it's like 5 to 10% rent to sales ratio, that's a good indicator that's a good location, and it's going to continue to perform whether or not you have that same tenant in that location. So always look at the traffic counts. Use a lawyer or broker to look at the details of the leases. Make sure that it's really a true triple net investment. And if it's an apartment building, make sure that those leases are bona fide leases. They're legitimate, and it's not month to month. If it is month to month, that could help actually. But in any case, make sure that there's a lot of good potential for leasing up that property in the future if the tenant moves out, whether that be apartment buildings or triple net. And last but not least, we look at the financial analysis of the property, do 5, 10, 20-year analysis to make sure that your investment is going to continue to prosper based on different scenarios with the economy growing in certain ways. So it's we kind of have an algorithm spreadsheet that we help you to look at the financial viability of that investment. So anyway, that's all what we do for you in a nutshell. But without further ado, Jim was going to give a couple more words of advice on financing, how that helps investors, how his bank's financing programs will help investors.
So I'm just trying to understand it. If I was an investor and wanted to get into triple net investing, do I buy a building that already has an existing Burger King, or do I buy a building that Burger King can build on?
Well, so what you're talking about is an existing building with a tenant versus a building that's being built, right? So that's a sale leaseback. What a sale leaseback is a corporation either builds or buys a property and signs the lease upon close of escrow. So those are generally very safe way to go when it comes to triple net investments. Sale leaseback is basically the corporation owning the property and selling it and leasing it back to themselves.
Nice.
Yeah. So either way, it's fine. I wouldn't buy a vacant triple net property.
So why would people sell triple net if it's profitable?
So it's a freezer investment. People have motivations to buy, sell any type of real estate. Same thing goes for triple net properties. Maybe the investment group that owns a property needs to raise capital to go into some other venture, or maybe the retiree, maybe it's an old lady, she needs to raise some money to pay for medical bill. Like, you never know what the motivation is behind the seller of a triple net property, but just kind of look at them like bonds, but stable bonds, but real estate.
And that's a great question, because and that's part of our jobs too. Joey, Rich, and myself. I mean, we're going to look at the property itself. We're going to critique it as far as cash flow, as far as the lease. We're going to analyze the lease, make sure we're going to make sure there's no environmental issues. So if they're selling it and you're wondering why they're selling it because it's such a good property, if we're saying that's a good property, that should tell you it's a good property. And then basically whatever reason that they have is probably legit that they're selling it. Believe me, if it's a bad property, we're not touching it. And a lot of it is like Modesto. I'm not lending in Modesto. I'm not lending in San Bernardino or whatever, there's certain areas that we look at. Las Vegas, great, used to be great. It's now coming back. Before, last year it was on the blacklist. Most banks, and I came from another big bank, they wouldn't even lend in Las Vegas. But now, this year, our bank is starting to look at it and say, okay, we'll entertain case-by-case properties over there. So it's just, we'll let you know. If we let you know that's good, you should feel comfortable that's probably a good property. Our niche is more of the investment properties. So we try to cater a lot of our programs towards investors, like foreign nationals coming over. Also, we have programs for them to where we're not going to verify the income because we know they have strong assets that they can verify overseas. We'll lend them 50% down, 50% loan to value. So again, we try to create a program that's going to be easy and that's going to be flexible for a lot of our potential buyers out there. So overall, I mean, we'll try to do our best to get it done. Any questions? Lending, I mean,
You guys lend in Georgia?
Yeah, we do.
You do?
yeah, we just acquired one.
We have the branches in Atlanta, Georgia.
Okay.
And we have foreclosures over there too. A couple of them. We have a small list of foreclosures. I'll send it out to you guys if you're interested. But yeah, we do have over there.
Okay.
Yes.
Is there a risk of the tenant breaking the lease and don't have a tenant for the next year or two?
Yeah, there's actually always a risk of that, and I always am real upfront when it comes to these type of properties. There's always risk and there's reward for every type of investment. With triple net investments, the due diligence period gives you that window of opportunity to see really if it's a good financially stable tenant. Do your background research, obviously, figure out what their rent to sales ratio is. At the end of the day, whether or not the tenant moves out, if that location is a good location, if there's 50,000 vehicles passing by at Burger King every day or at McDonald's, if the demographics are strong, they're growing, affluent population surrounding the area, it's going to be a continuously prosperous location, whether or not that tenant lives or rents that space out. If Burger King, that franchisee, just happened to go Belly or something like that, if it's a good location, any business is going to want to go in and do business. So it's first of all about location, about the tenant, the rent to sales ratio. So doing your due diligence will help you minimize that risk. But of course, if in the event, let's just say McDonald's Corporation for whatever reason goes bankrupt, they have actually a better credit rating with Standard & Poor's than the U.S. government, so it's a pretty safe investment. But you get a leasing agent, either from Remax Commercial or CBRE or whatever company you want to hire, but they work on these types of properties. Mark Sales. They specialize in leasing these retail properties out. So of course, it's, there's always a fee for leasing these things out, but then you get a guaranteed lease for a new tenant.
So let's say like on that McDonald's or that Burger King where it has 15 years left on the lease, and when you guys come in and give us a loan, how do you structure that loan?
Well, we follow up the lease. Number one, we try to follow the lease, but if you're requesting a longer term, we can look at that.
Okay.
The first, a little bit more specific. We mean, what am I looking for? The building itself first, the property.
Well, so let's say there's a 15 years left
Okay.
on the lease, and you said you would try to match the term of the
Exactly.
loan.
That's the preference of most underwriters are going to try to, because they're going to feel comfortable with that.
Because with 6.5% cap, and if you're going to put on a 15-year terms on it, probably it's not going to cash flow.
So sorry.
Normally, I recommend a 10-year fixed, 30-year amortization.
Okay.
That's my preference.
And at the 10 years, then you go back to the
But like because I think someone, like she asked, can you do 15? Yeah, we can do 15 if you're, confident that the property is going to cash flow, which a lot of them won't, because that's making the payment much higher. Commercial loan versus residential loan, totally different. And that's one thing I want to kind of share with you guys what we're looking for. When you go to commercial side, we're looking at a global cash flow. Okay, when you're buying a fourplex or a single-family home, we're literally looking at debts and income on your personal, right? Just straight dividing. That's it. Whatever the debt ratio, whatever. But 43% or something. On commercial, we're looking at total personal income, total business income, if you got a business, divided by total personal debt, total business debt. So that's how we call it global, because we want to make sure two items that we look at heavily: primary source of repayment and secondary source of repayment. The primary is going to be the building. That's all I care about is the building. So it's so important that when you guys find one, that when they send me the information, hey, that's my first job, is make sure that building qualifies. Okay, so I'm going to cash flow that building using all the data that's available to me. Once I'm comfortable, and if you want to know the formula, I'll email it to you, but it's basically just debt service, which is basically your net operating income divided by your loan payments. That's it.
So
Okay?
you guys still go by the DCR of 1.25? Is that what you're looking
Not necessarily, depending upon which type of properties you have. If you got a single tenant one, hey, we're gonna go 1.3 on that. If it's got like mixed use, a little bit more riskier, we're gonna go 1.4. Okay, so meaning for every dollar that you have in expense, I want $1.40 in income net, and that's that's cash flow in it. So that's number one. So once that passes that test, you're halfway there. You should be comfortable that this is a good property. Then, if we go full doc, we're going to cash flow you as an individual versus all your debts and versus all your business, if you have a business, where all your sources of incomes come in. Those two, if you qualify, will approve the loan, full doc. That's why a lot of people, a lot of investors are not going to qualify for that. Okay, for whatever reason, Chris, he's going to talk to you about the CPA side. Whatever you guys do with your CPA is up to you guys, but when it comes to the loan side, if I don't see it on paper, then I don't want to go full doc. That's why we have the no doc programs, like the multifamilies and certain ones that I can do full doc, no doc, because it's easier for investors. So that helps. And then also Belinda does the fourplex. In case you like fourplexes, they have programs on the branch side that can do fourplexes that without any type of income docs, but it's asset based more.
Yeah, we do from 1 unit to 4 unit that is no doc. So a lot of investors, they come from China or they come from Vietnam. They like to purchase the property and they were able to close the loan for them. And easy qualify. It's a 40% down.
So we try to be flexible, and it's a great program. I mean, especially 1031 exchange, you just sold property, now you want to get into another one, but you might not qualify. So this is a great program for you to utilize, get a fourplex or something. But same thing on the commercial side. We can structure something similar if, again, I'm going to be flexible depending upon your profile. That's basically it. If you give me a strong profile, I'll get exceptions for it. But if you come, you give me a weak profile, I'm not, we're not giving away money. That's, don't we're not like a loose bank. We try to be a smart bank and lend to the smart assets and the smart clients and make it easier for you. That's the benefit of us, is that we're going to be more efficient and easier to get the loans closed. Oh, someone have, yeah.
What was the rate on the 40% down?
For which type of property?
124.
Yeah, the
The
Fourplex?
124. Because this is a portfolio loan, we only have the one program. It's 3-year fixed. 3-year fixed program. Between 4.75 to 5.125.
Depending upon how many points you pay.
Depending on point that you pay.
But again,
It's good for
it's a great program.
investment property, or second home, or residential. It all the same interest rate. Yes. So if you already have like five loan with other bank or 5 private with other bank, each bank still can do it. Because our guideline that for one customer we're able to do 4 loans. Because our loan is portfolio, not the Fannie Mae, Fannie Mac, so we don't have the restriction on the property.
But on investment properties, 1 to 4 unit, you still do 40% down or 50% down?
40.
40. Okay.
40, yes.
That's our magic number, 40. I'll go 50 if you got like really, credit's not good or something like that. We try to go 50, but 40 is always a good number for us. 40% down. They like 60% loans. That seems to be the magic number with our bank. And again, you're going to ask me, why should I go with you guys versus somebody else where they can get lower? We try to be efficient. We're trying to get this done quickly for you to match, their selling dates, their closing dates. If you want to go through the headaches of it, that's fine. But I've been there, I've done that. But it's easier if you give me a path of least resistance. I'm gonna go with that path. So
for example, if money transferred in the last minute before the purchase,
I'm okay with
you
it.
care?
Yeah.
No? Oh.
As long as you show me, where it came from. But yeah.
But that doesn't
It's
disqualify
not,
them.
it's not so
We need
strict.
one bank statement.
Yes, we're not that strict on the
One bank statement.
seasoning. Because we deal with a lot of, great question, we deal with a lot of different types of clienteles. They got cash somewhere, they bring it over. As my recommendation is, you put the funds in our bank, then that's it. There's no verification anymore. We don't need bank statement, we don't accept letters of, deposit verification, we don't accept those. You either got to provide us bank statements or deposit, transfer the funds here. And then that's
You
it.
may transfer it to the
Yeah, open an account,
So
we
you
have to
park
have
your
that
money, you
relationship.
park your down payment money with East West
Ours
Bank.
is- yeah.
Then we're gonna work with the underwriter.
So that clears that condition, so you never have to worry
No,
about
push the button.
verification of funds. Yeah, just wire open an account,
Yeah.
and put your down payment in.
Hi, my name is Christopher. Today's topic, is 1031. So how many people have done 1031 before? So is it difficult?
I don't remember, but it was fairly difficult.
Right.
Because I had to exchange a property from Southern California up, and there was a lot of communication back and forth and stuff.
Right. So is the deal successful?
Yeah, I was successful.
Yeah. Because of 1031, basically, the concept is very simple, but then there's a lot of detail rules, and then it's pretty stressful. Me myself, I own 3 fourplex, and I did one lifetime exchange myself too. And the key for that, is you have to look for the both sides of the agents that they have experience in doing that. Okay. So then 1031 is basically, think about that. Okay, so you have a property for 100,000, and then right now it's 250. So if you sell it, so the 150,000 would be taxable. But then in order not to do that, so you have to buy the new property, what I call it the new property, to exchange for the old property. And then they have the 45-day rule, the 180-day rules. And the most important thing is to make sure that your agent representing you, and then the agent on the other side, they know that it's like an exchange. Okay? And then, so maybe on the safe side from your standpoint, what if I screw up in the transaction, then maybe you want to consider what they call a contingent sale. So that means if I cannot get a new property, so then I won't sell my old property. Because when I exchange my property, the one down in Monterey County, of course it appreciates a lot. Okay, I think it appreciates for about 250,000, and I don't want to pay tax for that. And then I exchange for property in the East Bay. What like kind means that you have the old property, and then you want to sell it, and to get a new property, but then the old property it appreciates, and then you don't want to pay tax, right? Then Code Section 1031 says that, okay, what do you mean by like kind? Say, let me focus on, because this is a huge topic, and then a lot of the complex rules involved, right? But then let's focus on the real estate only. So real estate only, when you think about the real estate, so it's just like a house. A house, how can you treat your house? Residence, right? Investment. Okay, now, then, in order to be for like kind, so you have to be investment. Meaning that if your house is a residence and then you sell it and then you have gain, then you have to pay tax. But then I believe you guys heard about the 250,000 exclusion. That one is meaning that say if you live there and own the property for more than 2 years, per person, you can exclude 250,000 without tax. And then if a husband and wife is 500,000. Okay, but then we're not going into that topic, for this seminar purpose. And then we're saying that okay, it's investment. So then, like kind means that this old property have to be investment, and then the new property that you get is also investment. Quick question: if I have property here in Santa Clara, I appreciate for 200,000 and I don't want to pay tax. So I want to buy a new property. The issue is, can I buy a property in Asia? Anyone knows that?
Where?
In Asia.
No, you
Oh,
can't.
you can't.
Country.
Yeah, be careful, okay? Because it would not.
We went to Brazil, it didn't work.
It didn't work. Well, it's smart. Why did you stand up and tell people? Okay? Yeah, it doesn't work.
Can you do it anywhere in the country?
Yeah.
Yeah, within the United States, yes. So just watch out that, okay? Because I have social clients that they want to buy some properties, in Mexico, and they say, oh, I have a property here, and then I want to buy, Mexico. When I retire, I will go down to Mexico, and then at this moment, my rental property here, I sold it for some gain, and I want to buy down there. It doesn't work. As I said, it must be business, right? So then, land is one example, and then say. Commercial building, residential building, and so on. Okay. Here, if it's a personal residence or a vacation home, so those won't work. Who knows this issue? Say, meaning that it's a very tricky issue. When I was an auditor, when I challenge the taxpayer is, think about that. You own properties. What do you mean by inventory? Right? Inventory is, it's all based on the intent. When you have this, property, this house, how you treat it, right? Inventory is, think about that. You buy it, and then you resell it very frequently. That's called inventory.
So if you buy a property, you flip it, is there a time frame, like 1 year, 2 years?
No. No.
So let's say my buddy here, David, he's a flipper. So he flips properties and then he would hang on to a couple of properties. He would rent them out, but after let's say a year or two, and he decides to 1031 on that, how would the IRS look at it?
Doesn't work. I remember one case I worked with way back in 1995, and then I won the case. Because if you guys read the Supreme Court case, let me tell you, okay, when you do with the IRS, let me ask you one common sense is, do you think the tax court case or the IRS code section, who has more power? Use common sense. When we are talking about, now you're the taxpayer, I'm the IRS agent. You from your standpoint, you don't want to treat as inventory. The reason for that, is inventory is ordinary income. So even you hold it for 2 years, you cannot get the capital gain rate. You follow the logic, right? Yeah. So then, of course, from your side, you always want to be capital gain. And then from the other side, of course, we always want it to be ordinary, right? So then we go back to the definition of, what does this mean? just remember, look at court case. And then if you have Supreme Court case, though, so basically they look at several components to prove the intent. That's how it proves the intent to the taxpayer that he holds several properties. And then we look at, say, when you have this property, how often you hold the property. Okay? When you say flip, what's that mean? There's an implied meaning that you hold the property for a very short period. And then what do you mean by short period, right? So then that's why they have court cases. It's 6 months short period or 6 years short period. Maybe for commercial huge properties, it could be 6 years, right? So because we think about, okay, we're residential, 6 months may be short and then 6 years may be long, right? But then it depends, right? If it's a big project, 6 years can be short, right? It depends on the intent, how frequent you buy and sell those properties. But then in my case that I work with, it's very obvious. How the guy do, is that he's in Palo Alto, way back in 1993. So then he's a contractor. He's really smart. At that moment, the Palo Alto property was about $300,000, very cheap. Okay, so he bought a lot of properties and then he totally tore it down, and so he rebuilt a new property and then he sold it. Okay, and then he always have from 6 to 9 property sets on hand. So that means the first one I bought it 3 to 6 months, I sold it for gain. But then at the same time I keep on buying other properties and then tore it down, demolish it, rebuild it, and sell it. Okay. So then for developers or traders, it doesn't work. Very basic calculation, say sales price 500,000, and then we always talk about the tax basis. Okay, because the seasonal is a rental property, so you guys heard about depreciation, right? So I bought it several years ago for $250,000, and then I depreciate for $100,000, right? So then my adjusted basis, you heard about CPA always talking about adjusted basis, right? Adjusted basis is the basis that, or some people call it cost, right? So then that's the cost. So then if you use that, subtract that, then here's the gain. And then if, assuming you don't do like-kind exchange, what would happen? You have 2 gains. So this 350, 100,000 will be ordinary income. Say if your tax bracket is 35%, you tax 35%, okay? Don't forget California. California is about 10%, and California doesn't have a distinction between the the capital gain or the ordinary income. Is always the flat rate. We only focus on the federal side, okay? So then the 350, then we say we have 100,000. Why you have 100,000 here? Because of the depreciation. What they call tax benefit rule, meaning that in the past, you take the depreciation of 100,000. Now you have a gain. You heard about all the time you recapture. So then this